at the Dow, big cap as you can get, it's rallied up to its 50-day moving average. And the 50 days well below the 200. That's a bear pattern. You look at the S&P, rallied up to the 50-day. The 50 days way below the 200. And there's nothing significant about that. That's the most ordinary bear market rally possible. It's not spectacular, not even interesting. Now you look at Nasdaq, that starts to get interesting. Nasdaq actually rallied up to the 200-day. It broke through the 50 and got all the way to the 200. Much more bullish looking than the Dow and S&P. So this tells you tech stocks are in better shape than, well, S&P stocks, a lot of which are financial, and tech and oil and everything else. And Dow, there's a lot of financials on the Dow also. But it's even more interesting when you look at the Russell 2000, which are small caps. Not only did they rally through the 50-day to the 200, they actually rallied above the 200, which is actually slightly bullish. So small caps are in better shape than big caps. They're starting to trying to create some bullish pattern. Technology is leading other industry groups based on what the Nasdaq is doing and is outperforming. And the market is, there's a big short-covering rally going on in financials, but the market's not buying it really. And they've not bought. As far as I'm concerned, they have not bottomed. Here's the Dow Jones going to the 50-day moving average. That's the brown line. Notice this big, thick green line. This is the support in January and March. The Dow broke this and then rallied. This is one other significant part of this chart pattern. And it's nowhere near that. Blue line's the 200-day. It's nowhere near that. Notice this rally began post Fannie Freddie. We're already 1 month into this rally. I'm expecting this rally maybe will last about 2 months. We'll find out. Although the government is really motivated to move the stock market up into the election. Okay, here's the S&P, that big, thick green line, same support. S&P broke it. It's gotten to that 50-day, nowhere near the 200. Here's Nasdaq. This is a different picture. The support at January and March held. It did not break it. This is bullish. This means Nasdaq is stronger. And then it got through that brown line and got to the blue line, which is a 200-day. Another indication Nasdaq is stronger. Also, that DMI pattern, which is in the middle, is a normal rally pattern. Neither the Dow or S&P have that. So, I mean, altogether, Nasdaq looks better. And this is like, you know, Nasdaq's filled with tech stocks. It also actually has some financials and all sorts of other stuff. But, you know, it's the place you look for tech. So this is sort of tech is doing better than other groups. Okay, here's a Russell, which is better, best of all. That same support in January and March held. It did not go lower, just like the Nasdaq, although the Dow and S&P did. And then it hit that blue line, which is the 200-day, and then zoomed above it. And it also hit that blue line in the last rally. So, I mean, this is trying to turn bullish. So the Russell looks best of all. And these are small caps. There's nothing special about the Russell. If we did other small cap indices, they'd look similar to this. This is just think small caps when you hear Russell. This is not new, by the way. If you look back into the 70s, you will see there was a period of a couple of years when small caps way outperformed big caps. They had huge rallies. Big caps went sideways, did nothing. You made no money on it. Big caps like the Dow. And you could make 20, 30%, you know, a big amount of money on small caps. And this was during an inflationary environment. So, I mean, this actually fits a picture if something like this happens again. Things are shifting in the market, and I think it's, you know, setting up, when the rally comes, here's the leaders, the next leaders that are going to show up. This is not a done deal yet, but if you look at these charts, you'll see small caps, tech are in much better shape.